Good morning, everyone watching live on BAM YouTube. Let me know in the comments which market you are tuning in live from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's hot sheet, I will discuss a rise in a key inflation measurement, home price outlooks from MBA and Fannie Mae, and Opendoor's earning report. Today is Friday, February 24th, 2023. I am Byron Lazine, and the hot sheet starts now. Thank you for being with me on this Friday morning as we close out week 6 of the hot sheet. We've gone live every single day that the market and bond markets are open. Hit the thumbs up if you appreciate that. Please consider sharing this with one person who wants a 24-hour look back on the housing market. Key inflation measurement this morning just came out. The Fed watches this one in particular very closely, and it rose 0.6% in January. That is more than expected. Okay, so the PCE index, the core personal consumption expenditures price index, increased this 0.6% for the month. It was also up 4.7% from a year ago. Headline inflation also rose 0.6%, and it's up 5.4% for the year. All of these numbers are higher than the estimates. Okay, so this is going to go into that bucket that we've seen since that job report came out. And we've seen all this hot economic data and inflation data over the last 3 to 4 weeks. It's going to go into that bucket as another negative check as the Fed meets in March, as when they decide, okay, am I going 25 basis point hike like we saw in the last couple of meetings, or am I going to go a 50 basis point hike? The expectation in the market has priced in a 25 basis point hike. It's why on today's news that just came out, it's why the Dow's futures dropped over 400 points before we started the show. They're down 405 points as I just refresh right now. We'll see what happens as the market is opening. But the Dow and the NASDAQ both down big as we start the day, because many people on Wall Street did not have a 50 basis point hike on this next upcoming meeting in March priced in. So they're reacting today to this news, and you see those stocks go down. If you have a stock portfolio, maybe don't take a screenshot of it, but let us know in the comments how you're feeling about it today. Okay, so up 0.6% for the month, up 4.7% for the year. Again, Wall Street had been expecting respective reads of 0.5% and 4.4%. So completely missed on that. And we will see them continue to potentially react throughout the day. When this article here came out this morning, just minutes ago, the Dow was off more than 300 points. It's already off more than 400. So a lot of red today on the stock market. These numbers suggest inflation accelerated to start the new year, putting the Fed in a position where it likely will have to continue to raise interest rates. The chances of a 50 basis point hike is way up. One measurement says that is now 33% likely. Just 2-3 weeks ago, that was down to 1 or 2% likely. Okay, there's definitely going to be an argument against it for sure. But Jamie Dimon, for example, JP Morgan Chase, says, hey, I think the Fed might have to go up over 6% on this federal interest rate. Right now, we're at 4.5 to 4.75 target range. A lot of people are like, okay, we're going to stop at 5.25. That's been the belief for maybe over a year that we're going to stop. He believes we may have to go up over 6%, or we may have inflation issues for the next 10 years. Okay, so a lot of people are very bearish. A lot of smart people in very big positions are very bearish right now. I heard a talking head on CNBC this morning say we may need 2 to 4 million jobs to come out of the market, meaning people losing their jobs. Okay, typically you don't see people accept a price cut in their wage, and so to stop wage growth, usually you wash out those jobs and then rehire at a lower wage. And so we're going to have some more pain. We're going to have some more pain in 2023. I believe, with what we've seen the last 3 weeks, we saw probably a head fake of good inflation data for a couple weeks coming into January. It was like January, the first week of January, second week of January was like, wow, we got some good stuff going on. But that wasn't a long-term trend. right? That was a small sample size. And I think we were hopeful that that was going to be the story for quarter one. That was going to be the story for quarter two. It clearly is not. We clearly have a long way to go to get inflation down to where the Fed wants to see it. We're seeing resistance these last couple weeks. This PCE index data today is another data point of more resistance. And if you're a home shopper right now, or if you're advising home shoppers, depending on their urgency to move right now, you might want to sprinkle in some caution into the way that you're advising them. Okay. We're likely going to see inventory go up, not down at some point this year. It can't get much lower. We're going to talk about where some of these 30-year fixed mortgage rates are projected to finish out the year. That factors into their buying decision. And we're already seeing pressure on prices. So we're at that weird point in a home price correction right now where you've got to be really careful with your advice to home shoppers. Okay. If whether you're a real estate agent or a consultant or what have you, your advice better be cautious, or you could end up looking pretty silly in a couple of months. Let's get into the Mortgage Banker Association home price outlook. Okay. They just released this week. Very interesting to see what Mortgage Banker Association, and then stay with us because we're going to go right into Fannie Mae's and see how those two look side by side. Okay. So Mortgage Banker Association reported this week that they anticipate home prices will decline in 2023, but by 0.6%. Not a big drop at all. One of the more favorable outlooks that we have on the table right now. Mortgage Banker Association thinking just over 0.5% for home price reductions in 2023. A little bit more bearish in 2024. They believe 1.2% home price drop for 2024. 2025, they believe will go up 2.1%. So Mortgage Banker Association is essentially saying, hey, for the next 3 years, expect no home price appreciation. You're going to be flat for the next 3 years. Everybody that was up 40% from the last 2 years, I think you'll take 0.5% if that's the case for 2023 decline. I think you would take 1.2% decline in 24 and then get all of that back in 2025. As long as you maintain that 40% gain, right? A lot of people are projecting it could be a lot more catastrophic than that. But that's what Mortgage Bankers Association released this week. That's what they believe. 30-year. Here's the big news, and we're going to get to Fannie Mae in just a second. Here's what I'm really looking closely at. Mortgage Banker Association believes that the 30-year fixed rate is going to end the year at 5.3%. We're basically we're going to probably hit 7% today, by the way, with where the 10-year is and what the markets are doing. Okay. We're staring down. We're pretty close to 7%. If you don't have perfect credit, you're definitely going to be up over 7% when you lock into a mortgage today. But they believe we're going to end the year at 5.3%. So that's good news. It's good news if a home shopper has the ability to wait. And I get it. There's buy downs out there in the market. And so if you find the perfect house right now and you're working with a lender that can buy down and, put you in a position like that and maybe give you a free, refi over the next 2 years, if it goes down further, there's products like that. Weigh out how much that's going to cost you for sure. But there's products like that. But 5.3% at the end of the year would be a welcome sign to home shoppers, especially if prices get pushed down throughout the year. Let me know in the comments if you do believe prices will get pushed down more than the 0.6% that Mortgage Banker Association is projecting in your market, or do you agree with that? Do you think that that's going to be the case for you? They believe that the 30-year fixed rate is going to end 2024 at 2.4%. Okay, so 5.3% at the end of this year on the 30-year fix, 4.6% in the end of 2024. In our daily download, we have everything, all our sources and all of these tables and charts available that we use each and every single day for you. If you sign up once, you're just going to get them sent to you every single day. So hit that link so you get all of this stuff. Very useful information right now. Okay, they've here on this table and just released just this week, February 21st, 2023. Mortgage Banker Association has not only the data we just covered, but their housing measurements. So housing starts where they think those are going to come in here in 2023 and 2024. Home sales, total existing home sales. Okay, so again, they believe we're going to drop down to that 4 They're not all the way down to 4 million where we're at on the seasonally adjusted number right now. Right now, it's at 4 million. We covered that yesterday on the hot sheet. They're projecting 2023 total existing home sales is going to be 4.3 million. Okay, far off of last year's at 5 million. And they believe 2024 will be back to the 5 million mark. So they think, this will be the low point here this year for total sales. I think we'll continue to plummet. There's a really interesting chart here from Discipline Funds, which shows you how sharp this drop in existing home sales has been. Obviously, if we take a look here at this chart, this drop here is COVID, right? Things stopped on a dime. This is longer, what's happening right now, longer and sharper than COVID. Where we're at right now, longer and sharper than COVID, okay? We're approaching this historic drop in existing home sales, referring back to 2006, 2007. So that puts it into perspective how sharp, how fast these existing home sales have dropped. Inventory being an enormous contributor to that. I don't want to not highlight that. We know that demand is down, but inventory is down in a significant way as well. There is pent-up demand for a lot of millennials who haven't applied for their mortgage, but they are out there shopping. Okay, if you talk to a lot of agents in median price points and below in rural and suburban markets, they'll tell you that story. That's a real story. That's not big short fluff. Okay, that's actually happening. But at the same time, there are things that are pushing against that we need to recognize. And whether you're an attorney, whether you're a lender, whether you're an investor or somebody consulting somebody on their home sale or home purchase, all of this data that's coming in at us every single day, it's important to understand it. It's important to take the 20, 30 minutes here that we do on the show every single day and get updated. Because the headlines that were going on 3 weeks ago, right, where you saw almost every national headline talking about mortgage rates are dropping. If you regurgitate that as a script for the next 3 weeks, you will get exposed because that's not the case anymore. And while we're looking at Mortgage Banker Association telling us that, okay, we're going to end the year at 5.3%, and that's really good news. I like that Mortgage Banker Association is saying that. That's also not where we're at right now. That's not reality for somebody who's going in and trying to apply for a mortgage. Okay, so the 30-year fixed rate, quarter one, they're looking at an average of 6.4%. We're staring down at 7 right now. Okay, quarter two, 6.1. So they don't think that we totally come out of this higher 30-year fixed mortgage just yet. Going into quarter two, 5.7 though in quarter three, and then we get to 5.3 at the end of the year. And listen, historically, we know that, that winter time home shopping is pretty good. So if you're a buyer, you got the ability to wait a whole year. Listen, agents, I know nobody wants sales to wait, but we can already see that the projections are clear. We're going to see about 4 million home sales this year. It's an enormous drop. It's a 20% drop from last year, where we were lower than the year before. Okay, so we're going to see less sales. We're going to see more patience in the market. The knowledge brokers, which we've got the Knowledge Broker podcast. We'll go deep on some of the stuff today, premiering at 2:00 at Knowledge Brokers podcast over on YouTube. The knowledge broker is going to be able to build a lot more trust by educating their buyer. And listen, I've been doing this since 2012. In 2012, when we had a market that bottomed, I would give people this advice. Hey, we got to be cautious. We got to be careful. There's a lot of inventory. You got a lot of opportunity to take your time. And there's going to be buyers that say, I don't got the time. I'm going now. I'm moving now. You with me or not, Byron? Right? How many of you have heard that in the comments? So as long as you have more conversations than anybody else, as long as you put in the work as a real estate agent, you don't have to worry about, how's my business going to be? That's up to you. Gary Keller said this week, match hard with hard. It's a hard market. Put in the hard work. That's all you got to do. Okay. Also, let's take a look at Fannie Mae. Let's see what they have to say. How are they different from Mortgage Banker Association? Okay, 2023 U.S. home prices, they believe, are going to decline 4.2%. So we had Mortgage Banker Association saying 0.6%. Fannie Mae, very bearish on the pricing, negative 4.2% for 2023 U.S. home prices. That's a drop for this year on top of any drop that you experienced at the end of 2022. Okay, Fannie Mae also believes in 2024 will drop another 2.3%. Okay, so now if you're a home seller and you're seeing that data, and you believe Fannie Mae over Mortgage Banker Association, you could say, well, I've already lost 5% of my home the end of this year. If I wait till the end of 2024, I'll be down maybe 12, 15%. Okay, so somebody's looking to sell. If you're a home seller in 2023, I've been saying this a lot. You gotta go now. Now's the time to go. It's a February opportunity. I think the opportunity gets worse later in the year. Relocations are coming in and buying now. Dawn, and I believe Dawn's down in Texas. So Dawn, what type of relocations are you seeing in your market? Is that job related or is that lifestyle related? Curious to know. 2023 Fannie Mae average 30-year fix 5.9%. Okay, so Mortgage Banker Association says we're going to end the year. These are two different measurements. We're going to end the year at 5.3%. Fannie Mae says our average 30-year fix is going to be 5.9%. Okay, down from their last month where they said we're going to be at 6.3%. So Fannie Mae adjusted down on the 30-year fixed. This is good news that both Fannie Mae and Mortgage Banker Association agree that on their updated measurements that just came out this week, and they're more positive than what they were saying just a month ago, is that the 30-year fix is going to head down. Keeping Current Matters has done such a great job of reporting this. When we go into recession, which we're likely going to go into a recession if the Fed takes this really heavy action in March, when we go into a recession, we typically see that 30-year fix comes down. Okay, so I believe when I see this, that Fannie Mae and Mortgage Banker Association both believe that, recession fears are not just elevated, but they're likely to happen. Okay, here's Mortgage Banker Association's projections for 30-year fixed. 2022, we had 5.3% average 30-year fixed. It seems crazy because we know it hit 7.3, but remember where we started the year in 2022? Okay, they're projecting this 5.9% average, which is down from 6.3%, which was their projection last month, and then 5.2% in 2024. So next year, 5.2%. They're not as bullish as Mortgage Banker Association, which believes that, Mortgage Banker Association believes we'll end the year at 4.6% 30-year fixed in 2024. So we certainly could end the year at 4.6 on this Fannie Mae one, and average the year at 5.2. That makes sense. That makes sense to me. Okay. They've got their total housing starts here. Of course, this is going to be available for you down below. I thought what they're projecting, Mortgage Banker Association and Fannie Mae on the 30-year fixed, how that's going to work out for the year was more important than anything, but they've got all their other data in there, which you can get into the daily download link below. One link to get all the sources and all the tables. The first quarter, they believe we're going to be averaging 6.16%. So both Fannie Mae and Mortgage Banker Association does not believe we're going to have an average in the first 6 months with a 5 handle on the 30-year fixed. Okay, 5.9 for quarter 3, and then 5.7 an average for 5.9. I mean, listen, this looks very consistent and flat for the year on the 30-year fixed. It's certainly not the environment we've been in. It's been like a up and down volatile situation. That looks beautiful, Fannie Mae. I'd love for us to have some consistency, for home shoppers to not feel like tomorrow it could be up a half a point or down a half a point, or what's going to happen next week if I find the perfect house. Where's the 30-year fix going to be? Nobody knows, because nobody can tell me, because it is just crazy and changing every single day. Okay, what seems to be changing all the time in the downward trend is the outlook on Opendoor. Opendoor posted their earnings today, and they post heavy losses after losing money on home sales, reading from Wall Street Journal. Online house flipper reports a net loss of $399 million for the fourth quarter. Okay. The company said it had $2.9 billion in revenue from selling 7,512 homes in the fourth quarter, which is down 25% from the same quarter a year ago. The balance of those sales left Opendoor with a net loss. So they sold 7,512 homes and they had a net loss on those sales, measured accordingly to generally accepting accounting practices. The 399 for the fourth quarter, 399 million for the fourth quarter, 63 cents a share. The net loss for the same quarter in 2021 was 191 million at 31 cents a share. So they are losing and burning more money at a much more rapid pace. Opendoor's loss for the full year of 2022 came in at $1.35 billion. That's more than their market cap. Okay, their market cap's just about $1 billion. Analysts had expected a net loss of $533 million in the fourth quarter, according to Fact Sheet. So shares of Opendoor fell 1.6% to $1.82 a share on Thursday. Remember, every time they get close to that dollar mark, they're at risk of being kicked off of the out of the stock market there. So not good for Opendoor for sure. They've got this partnership right now with Zillow. We'll see how that works out for them. I'd love to see what do the executives say. Opendoor executives have attributed many of the company's losses to its decision to honor purchase contracts they signed before hire. Yeah, Opendoor, that's how it works. When you go in a contract with somebody to sell a house, you got to honor it, or you have some, you're going to have some legal issues there. So you decided to do the right thing, the legal thing, and honor your contracts. Way to go, Opendoor. That's what you're supposed to do. Now, it's not anybody's fault that you made poor decisions on predicting the market and understanding the market dynamics of what's going to happen when you're a house flipper at this scale. The risk that you took the risk and you got punched in the mouth. The company has since sold about 2/3 of those homes purchased last spring. Okay, they went on a buying spree last spring. Did it at the wrong time for sure. Purchased last spring, according to the fourth quarter shareholder letter. It expects to have sold more than 85% of them by the end of the current quarter, losing about 4% a home on average. One of the things I thought was interesting is the company also said in its letter that expects more positive results for houses it purchased in the recent months. How? What? Because they're playing in markets that have big drops right now. So you've purchased homes in recent months and you expect more positive results. There's downward pressure on price in a much bigger way than suburbs and rural America, which Opendoor is not really playing in. I don't know. I just don't know, Opendoor, how you can project that. Your projections have been wrong the last year. So I don't know how you say that in your letter to investors and they feel good about it. Okay. They're talking about a measure of profits 4 to 6% on homes. I'd be really surprised if that happens. Okay. Let's see where they're at today. They were down in pre-market. Let's just see where they're at right now. Yeah, they're down to $1.66 a share. That's down 9% on the day. Their market cap's getting close to dropping below $1 billion again. I don't know. Let me know. Are you a buyer of Opendoor? They've got the partnership with Zillow. We'll see how that works for them. I think it's going to benefit Zillow to generate lead flow for their partners. Not sure how much it'll benefit Opendoor. Let me know what your thoughts. Would you buy the stock right now today at $1.66? Let me know in the comments if you are a buyer of Opendoor right now. I don't see any of those YouTube comments I used to see all the time. They're a market maker. They're going to change real estate. I don't see that. They're a house flipper at scale, and we know how risky house flipping is. And certainly in a year like 2023, house flipping is going to be a dangerous game to play. Okay, you got to really know what you're doing in that local market. Having a bunch of college kids make decisions for you behind a computer can put you in a vulnerable position. And I get it. Analytics are a real thing, but this isn't the Oakland Athletics. This isn't Moneyball. These are different local markets, and we know real estate is always a local game, which is why in your market, you need to be the Knowledge Broker. We're going to have the Knowledge Brokers podcast up today at 2 p.m. Myself and Tom Toole. It's not on this channel. It's on its own channel at Knowledge Brokers Podcast, presented by BAM, of course. Go check that out. Make sure you sub. hit the notification bell over there so that you're ready for today's 2:00 show. We're going to go deep on a lot of this stuff. Really appreciate you guys being with me all week. Make sure you're subscribed to BAM if you are not already. I will be back Monday live, 9:30 a.m. Eastern. Oh, wait. If you're still with me, we haven't checked out the 10-year, which is more bad news, unfortunately. Maybe that's why I was avoiding it. Yep. Still bad news. Okay. Maybe I should just skip it. Maybe we should just skip it and hope for good news on Monday. Hit the thumbs up if you'd rather just see good news all the time. All right. 10-year treasury is up. Okay. 3.94. We can watch it tick up a little bit more. There it is, 3.492. And the 30-year yesterday ended at, that wasn't yesterday. Sorry about that, folks. 30-year did go down for the first time. That's right, 6.82 from 6.88. We finally saw a tick down after about 3 weeks of daily tick ups. I expect this to go back up today with where the 10-year is at. All right, hopefully I'll have more good news for you, or some good news for you Monday morning. But the news is the news. The facts don't care about our feelings at all. They just are what they are. So we need to know about this, and we need to be updated daily so that we can better advise people and not headline read from 3 weeks ago and get completely exposed as a clown. I hope you guys have a phenomenal weekend, a great Friday. Hope to see you over at Knowledge Brokers Podcast later today. And until Monday, toodaloo.